whenever the markets come down, the financials lead them down. Typically, when we get that little euphoria and the positive momentum, the financials lead on the way up. So it's just reflecting that we have something else that's given us a catalyst for that anxiety about some recession or some pullback in the economy, and the financials will begin to show that.
Interesting, because Paul Donovan from UBS was on earlier this morning, and he was talking about how the interest rate picture is not indicative at all of what's happening with the global economy these days. It's manipulated. There's central bank intervention. Yes. But interest rates still matter to the banks. They still matter to financials. So with interest rates at record lows, are banks the place to be?
Well, what happens is, as we saw interest rates going up in 2018 and then so quickly come down in 2019, that head fake really was unfortunate for the banks. What happened was they were paying depositors, so deposit rates were going up, and then when rates started to come down, they couldn't really lower those deposit rates. They now have the chance, so they do have some kind of headline news that rates are coming lower. So we think that there'll be some recalibration on deposits that could offset this last round of lower interest rates.
There's been an interesting relative performance gap that's happened within the banking sector. We've noticed that with the interest rate picture developing the way it has, that regional banks, or those exposed to more of those net interest margins, the lending and kind of investing side of the business, that has underperformed a bit over some of the larger money center banks. Is that going to play out again in 2020?
Well, it has been, because just the dynamic you're talking about, the interest rate side. But what you have is a couple of these banks that restructured their balance sheets.
Like who?
Yes, so like Fifth Third add duration into the securities portfolio. Their margin is actually holding in pretty well. Regions Financial restructured 20% of their balance sheet with derivatives. These two banks aren't getting the credit yet. So as they begin to perform and their net interest margins do better than the rest of the regionals, they'll begin to outperform.
All right, so let's then talk about where exactly, you're a banking analyst. Yes. You cover these stocks. What exactly should investors be doing given the pullback that we've seen? Is this a time to add, and if so, to what?
So what we do is, when we go through these corrections, we wait for it to stop. As long as you're seeing red, it's not going to change that quickly. Let's stabilize. Once we stabilize, we do think we have a better entry point. We had downgraded the stocks back in December because we thought we were on the euphoria trade. Now what we're doing is we're going back into the anxiousness about recession and the impact of the economy. Okay, let's pick our spot once we see that stability come into these stocks. Then what you do is, in the first quarter, the universal banks do better. So you have the trading. We saw yesterday at JP Morgan's Investor Day, they were talking about how well the trading had been doing in this market. So we're actually seeing things like Citigroup, Goldman Sachs would be names that we had initially kind of get into. Once we get this stabilization, we look for regional banks that have heavy discounts, like you talked about. They've underperformed. Let's look at those that are uniquely positioned to be able to not be hurt as much in this environment and have some other catalysts that can push some earnings higher.